But first, as we always do here, we begin with the markets. The Federal Reserve is widely expected to cut interest rates for the first time this year. Later this week. Joining us to talk more about it is Greg Farinello. He's the head of U.S. rates at Ameribet Securities. Greg, welcome to the show.
Ashley, thank you so much for having me.
So we have been hearing about this September Fed meeting for so long. All eyes are on the Federal Reserve Wednesday at 2 p.m. What do you think is going to happen?
So I think it's probably sets the tone for the rest of this year and even into 2026. So the Fed's going to come down. We expect them to come down 25. You can make an argument that maybe they should come down a little bit more aggressively, but they don't like to surprise markets. Certainly changes are going on within the Fed committee itself. We know we're going to get a new Fed chair at the same time, but the balance of risks here, the way I see it, is, and even Chair Jay Powell is saying, you know, we've shifted a little bit away from the inflation side of the equation and more toward the employment side. If you look at the jobs reports, if you look at the revisions that we got for last year, they're pretty meaningful. And so we expect the Fed to come down 25, but we don't expect this to be one and done. We expect this to be a series of rate cuts going forward.
All right, and 50% rate cuts, some think like this might happen. Do you think the Fed is going to go that aggressive?
50 basis points?
Yeah.
I don't see it. I think I can make an argument to myself that they should, but, and I know the administration wants rates to come down a lot here. I think what they will do is take a more methodical approach, keep an eye on the data, and look, it's not a bad way to go, right? If you look at where the market is anticipating rates to be in 2026, at the end of 2026, we get down to 3%. So the question is, how quickly are we going to get down there? The other thing, too, with this Fed meeting is we get a new summary of economic projections. The Fed's longer-term neutral rate is at 3%. So the question is, how quickly do they want to get to more neutral levels? And I think what we'll see this week is a signal from the Fed that, we've gone 25 and we're likely to go a little bit more as the year progresses.
Yeah, can you get into that a little bit more? What are you expecting for the rest of the year?
So, I mean, they could certainly go at every meeting from here on out. So we have 3 meetings left. They could go 25 at each meeting. If you look at market pricing, that's where we are. And they could certainly go into early next year. But I think they will evaluate the data over time. So I think what you'll hear from Chair Powell is, look, we went 25. We are watching the labor market here very closely. And I think they will be data dependent. He will signal that every meeting going forward is a live meeting. And what we mean by that is everything is on the table right now in terms of when they come down and how quickly.
And Powell for months has underscored the Fed's commitment to a 2% inflation target. But seeing how they're about to potentially cut rates for the first time, do you think that 3% is the new 2%?
I kind of do. I mean, I'll say it, and I've written it to clients. I know they are steadfast on this 2% number, but when all is said and done, and, keep in mind, too, like the Fed, unlike other central banks, the Fed has this dual mandate, so they need to balance it out. If you look at the CPI numbers, we're running around 3%. If you look at the PCE numbers, which they monitor pretty closely, we're, 2.5% to 3%. So I won't say 2% is out the door. He's not going to say that ever, I think. But in my mind, I think they're looking at the labor market here front and center. And although inflation is running above their 2% target, it's not going to stop them, I think, from lowering rates here.
And when the Fed cuts rates, we know that risk assets tend to rally. So what specific asset classes do you think might benefit from a rate cut?
Well, I think we've already seen it, right? Equities have done great. I mean, we watch credit very closely. And when we watch credit, it flows into equities. So that forms that opinion there. Volatility in general has come down across the board. If you look at the VIX, if you look at the MOVE index for U.S. Treasuries, if you look at the CDX index for investment grade credit, everything has really, really come down here. So, we've rallied a ton. I would say this much. It's monetary policy is important here. We've already priced to a certain scenario. But on the fiscal side, I mean, what's coming out of Washington and what's coming out of DC right now, I think is probably more important than what we're seeing coming out of the Fed. So I think if you combine good policies potentially coming out of Washington at the same time with a lower rate environment, I think that's a good environment going forward for risk assets. And on the capital market side, I mean, the markets have been completely wide open, whether it's the equity side, the debt capital market side. I mean, there's been a ton of activity. And I think that's going to continue into 2026.
And what's your take on the current state of the economy?
I think we're okay. I mean, it's look. I mean, we're running GDP, real GDP, 2.5 to 3%. I think the economy is, it's certainly slowed down. There's no question about it. I mean, tomorrow we get retail sales, but to me, I think the economy is in relatively good shape. If you look at the employment market, the dynamics are clearly shifting a little bit here. You look at the revisions, what we're printing month to month has changed. So I think the interest rate structure needs to come down here as we reprivatize the economy from the public sector to the private sector. But I think overall, I think the economy is going to be in pretty good shape going forward.
Great. Thank you so much, Greg Farinello, head of U.S. rates at Ameribet Securities. Thank you for joining us at the New York Stock Exchange.
Thank you, Ashley.